The retirement plan, praised as a wealth machine, often becomes a quiet tax trap, not because saving is foolish, but because the structure changes the outcome. A man works 40 years, contributes faithfully, and believes he is building freedom. Then retirement arrives, and the government shows up as a silent business partner. The balance looked like his money. It was never fully his money. That is the contradiction nobody advertises. Tax deferral feels like victory when you are contributing. It can feel like a cage when you are withdrawing. And most people never study that second half. They are trained to chase the deduction. They are not trained to model the exit. That is how the trap works. It rewards obedience at the front door. It punishes ignorance at the back door. A 401k is not bad, but it is not the same thing as wealth. Wealth is control. Wealth is optionality. Wealth is after-tax purchasing power. You can direct without begging permission. A large pre-tax number can impress the eye. It does not guarantee freedom. Trap 1. The deduction seduces people into ignoring the future tax bill. The present feels lighter. The future becomes heavier. You save taxes today at your current rate. You withdraw later at whatever rate the system demands then. That is not tax elimination. It is tax relocation. And relocation without control is not strategy. It is surrender. Most workers assume retirement means lower taxes. Sometimes that is true. Often, it is only partially true. Pensions, Social Security, required distributions, and investment gains all stack. One stream becomes a river. That river can push you into brackets you never expected. Mechanism 1. The account grows tax-deferred, but the liability grows with it. Every gain inside the account fattens a future claim. The statement does not show that claim clearly, so people mentally spend money they do not fully own. That is an accounting illusion. Illusions are expensive when they mature. Trap 2. The plan teaches concentration in one future tax regime. That is a dangerous form of risk. People diversify stocks, but ignore tax diversification. They build one giant bucket with one giant rule set. Then lawmakers, not markets, become the variable that matters most. If tax rates rise, your future math changes. If distribution rules tighten, your flexibility shrinks. If healthcare thresholds punish extra income, the squeeze gets worse. Mechanism 2. The government delays collection, then forces timing later. That timing matters more than most people understand. You may prefer to leave money untouched. The rules may not care what you prefer. Required distributions are the machine turning on. The account stops being a shelter and becomes a faucet. You do not fully choose the flow. The system does. That is not freedom. It is delayed obedience. Trap 3. People confuse contribution discipline with investment intelligence. Automatic payroll deductions feel efficient. Sometimes they simply hide passivity. Fees, limited menus, and poor allocation decisions quietly drain returns. Not with drama, with silence. A silent leak is still a leak. Compounding works for owners. It also works for intermediaries. Rule 1. Never evaluate a retirement account by the balance alone. Evaluate it by net access, future taxes, fees, and withdrawal flexibility. The gross number is theater. The net number is reality. Rule 2. Match money is usually excellent. Free money deserves respect. But beyond the match, blind devotion becomes dangerous. The first dollars may be obvious. The later dollars require thought. Rule 3. Tax buckets matter more than financial marketing admits. You want pre-tax money. You want post-tax money. You want taxable money with flexibility. A fortress has more than one gate. Retirement planning should work the same way. Truth 1. Tax deferral is valuable when paired with a tax exit plan. Without that plan, it is merely delayed complexity. Truth 2. The best account is not the one with the biggest headline number. It is the one that lets you move intelligently in retirement. Truth 3. Control improves returns you actually keep. The investor who can choose timing often beats the investor with the larger statement, not because he earned more, but because he leaked less. This is how disciplined allocators think. They do not worship accounts. They study systems. They ask what rules govern access. They ask who controls timing. They ask what happens when the law changes. They ask what remains after tax, inflation, and fees. That is adult investing, not optimism. Arithmetic. The escape path begins with brutal honesty. Estimate what part of your 401k actually belongs to future taxes. Stop staring at the gross total as if it is cash in hand. Then examine fees with the same seriousness you examine returns. A small annual drag becomes a large lifetime theft. Next, build tax diversity outside the plan. Not to abandon the 401k, but to stop depending on it alone. Consider Roth space when appropriate. Consider taxable brokerage for flexibility. Consider cash reserves as strategic breathing room. Margin is not laziness. Margin is control. Then protect attention. Because bad financial decisions rarely begin with numbers. They begin with haste, fear, and borrowed assumptions. Noise keeps people in the hamster wheel. Clarity helps them step off. This is not a message against retirement saving. It is a message against financial obedience without understanding. Use the machine when it serves you. Do not let the machine define wealth for you. The worker believes the account balance tells the whole story. The operator studies the invisible terms beneath the story. That identity shift changes everything. You stop chasing appearances. You start building usable power. You stop asking how to maximize a deduction. You start asking how to maximize freedom. That is the right question. Because retirement is not a spreadsheet contest. It is a control contest. And control belongs to the person who plans the exit early. If this channel helps you think like an owner, subscribe. Not for noise, for clarity. The 401k can be a tool. It can also be a polished cage. The difference is not in the brochure. The difference is in how you use it. Not because tax deferral is worthless, but because wealth without control is an illusion. See the trap. Name the mechanism. Build the escape. Protect your margin. Direct your capital. And never confuse a deferred tax bill with freedom.